classic, the triple Lindy, right? He finally pulled it off after all those years. That's how investors feel trying to weave through this, right? It's frustrating. Of course, risks are beginning to escalate because selling can beget selling, but the opportunities. Now, this week, it was the plugins from Claude, right? Accelerated all the pain in software, actually triggered selling in a variety of industries. Now, my first guess says that everyone should just take a breath and think this all through. Joining me now is Siebert Financial Chief Investment Officer Mark Malek. And Mark, you've got on one side the traditional SaaS model, on the other side this Anthropic Claude model. I mean, if you just go down to the bottom, it's like $20 a month, not too bad. Here, it's a lot more expensive. But is it too early to tell? Is it too early for the kind of carnage that we're seeing?
I think so for sure, but it's an important theme for us to start thinking about right now. It's important to recognize that it's not Claude per se that is competing with these companies, but it's what Claude can do that other companies should be employing today to be competitive in this market.
So you've got all kinds of names, right? You got Thomson Reuters, which is down significantly. This is just 48 hours after these, these new plugins were put out. We saw, of course, the connection to private equity. Moody's getting hammered, Expedia getting hammered. It's just so many big businesses with comfortable profit margins. It seems if there is a legacy to this, or if it does continue this way, at the very least, they lose some pricing power.
Absolutely. I mean, look, it's really important for these companies to get it right, get involved in that early on. The companies like Thomson Reuters embrace the technology, and the messaging is so critical for us investors to understand what they're going to do to use technology to make their businesses better.
So for the last few years, I argue going back to 2009, buying the dip has been phenomenal. You and I have talked about that a lot. Webpush out now this morning saying there are 5 software names that they think you should own. They talk about this software apocalypse, but they say, hey, Microsoft, Palantir, CrowdStrike, Snowflake, Salesforce, that these names are probably overdone here.
Yeah, look, I can't argue with Dan. He knows what he's talking about. I agree. I think, look, Microsoft is a great company. Technically, it needs to do a little work there. There's a gap. It's a little bit of a detrending.
They got a downgrade this morning and a pretty hefty price haircut. I forgot the firm, but it was a top-tier firm.
Yeah, I mean, the chart is not pretty, but the fundamentals support it. The long-term thesis on the company is still very, very strong. And of course, we've talked about Palantir, huge upside.
Right.
Again, all these companies right now, a little early.
All right, so let's talk about the stocks that you've been looking at. You say these are winners, obviously, under pressure. Advanced Micro reporting yesterday. You know, what's interesting, folks, you see there's a gap. We deliberately left this chart formation, even though it looks jagged. There's a huge gap there. You go back to October. The stock was absolutely on fire, sort of spinning its wheels. And then, of course, there was an opposite gap yesterday to the downside, despite what everyone thought was a pretty good earnings report.
Yeah, I mean, it's a bit of a challenge. I mean, that big gap there is what has all of us with our eyebrows raised. Is it going to fill that gap?
Right.
And
ironically, if it did, it'd probably be touching the 200-day moving average.
Yeah, I mean, well, the bottom line also is that, look, the trend is still positive. The secular trend is still positive. So, again, this is something where you can get in over here, but you get in with a little bit less conviction. You wait till it retrends.
All right, speaking of tickling the 200-day moving average, NVIDIA did that. It's up a little bit, at least when I came down to the studio. Obviously, it keeps feeling like they're in the clear, right? They have an earnings report. It's phenomenal. They've cleared every hurdle, and yet the stock hasn't. What's going on?
Yeah, I mean, it's still a challenge. I mean, obviously, I don't know why it's such a challenge, because it's pretty clear that they should not be affected by any of these negative headwinds that we have right now. And the fundamentals support all the growth that's out there. Who's growing at their pace that they're growing at with their earnings per share? Going
back 2 years ago, Wall Street said there's no way these hyperscalers can keep spending this kind of money.
Yeah.
And they keep doing it. Now, the quibbling last year into this year was, well, now they have to use debt. Google Street thought Google was going to say 119 billion with respect to CapEx. Yeah. No, last night they said 185 billion. Meta, the Street thought 110. They said maybe 135 billion. Amazon reports after the bell probably will do more than 145 billion the Street's looking for. And yet, it's, Meta got hammered the first time on the news. This time around is acting a little bit better. Would you rather see them do the CapEx or buy back stock? I mean, why is there so much resistance against these companies investing in this?
I think it's maybe misunderstanding, right? It's what they provide to the overall ecosystem that's so critical. Look, we all believe that AI is going to change everything. All of these companies are necessary to get there. So regardless of who wins, whether it's Thomson Reuters or somebody else, they still are going to need this ecosystem to get the AI to generate those great productivity gains.
So are you buying these? Are you holding them? What would you do?
Oh, absolutely. These again, they're critical. I mean, we're buying them, and they must be spending their money right now on this. We've seen them miss these opportunities before. They know they can't miss this opportunity. Look, CapEx is a dangerous thing. However, these companies, they have the balance sheets to support it. So as long as they can do that, and they're showing that they're prudent, these are the way to go.
I think you equated it. Did I read somewhere where you equated it to sort of Kodak missing out on the digital camera, even though they invented the digital camera?
Exactly. So if companies don't embrace it now, they can go the way of the Kodak.